Something has shifted in the silver market that most investors haven't noticed yet. Not because it's hidden, not because the data isn't available, but because the implications are so far outside normal market behavior that even experienced observers are hesitating to acknowledge what the numbers are showing. This video is for two groups of people. First, those who already hold silver and want to understand why the landscape beneath this asset has fundamentally changed. And second, those who don't hold silver but are watching the macroeconomic environment deteriorate and wondering if there's a rational case for alternative stores of value. What I'm about to share isn't hype. It's not a prediction. It's an analysis of observable market conditions, historical patterns, and the structural forces that create pressure in commodity markets when supply, demand, and financial positioning move in opposing directions. If you're looking for entertainment or quick dopamine, this isn't that video. But if you're willing to think through the implications of what's happening right now in precious metals markets, particularly silver, then what follows may change how you view the next 12 to 18 months. Let's begin with what's actually happening. For decades, the silver market operated within a predictable range. Industrial demand created a floor. Investment demand created occasional spikes. Central banks largely ignored it. And large financial institutions used derivatives to manage price volatility and profit from predictable cycles. That system is breaking. Not because of a single event, not because of a conspiracy, but because the fundamental variables that kept that system stable have all moved at once and in ways that create compounding pressure. Start with supply. Global mine production has been essentially flat for years. New deposits are harder to find, more expensive to develop, and take longer to bring online. Recycling provides some secondary supply, but not enough to offset demand growth. Now layer in industrial demand. Solar panel manufacturing alone is consuming more silver than at any point in history. Electric vehicles use significantly more silver than combustion engines. The ongoing infrastructure build-out in developing economies requires silver for electrical systems, telecommunications, and renewable energy projects. This isn't speculative demand. This is production demand. Companies need physical metal to manufacture products. When they can't get it, production slows or stops. Then add investment demand. As confidence in fiat currencies erodes, as government debt levels reach historic extremes, as inflation proves more persistent than central banks predicted, investors globally are increasing allocation to hard assets. Gold gets the headlines, but silver offers something gold doesn't: dual demand drivers. It's both a monetary metal and an industrial commodity. When either demand vector strengthens, price responds. When both strengthen simultaneously, the dynamics become exponential. But here's what makes the current situation different from previous cycles. Silver, like many commodities, trades in two markets: the physical market, where actual metal changes hands, and the paper market, where contracts representing silver trade on exchanges. In theory, these markets should track each other. In practice, they can diverge significantly, especially when the paper market grows much larger than the physical market it's supposed to represent. Right now, estimates suggest the paper market for silver is anywhere from 100 to several hundred times larger than the available physical supply. Let me be clear, no one knows the exact multiple because much of the derivative market operates in the shadows of over-the-counter transactions between institutions. But we know enough to understand the structural problem. When financial institutions sell short positions in silver futures or derivatives, they're making a bet that the price will decline. In normal markets, this provides liquidity and price discovery. It's a necessary function. The issue arises when short positions become so large relative to physical supply that covering those positions in a rising market becomes mathematically problematic. Think about what happens if silver prices begin to rise, and short sellers need to buy back contracts to limit losses. They're competing with industrial users who need physical metal for production. They're competing with investors who are buying because they believe the macro environment supports higher prices. And here's the critical point. Short sellers in the derivative market can't manufacture physical silver. They can only buy what exists. And if what exists is already committed to industrial use or held by investors unwilling to sell at current prices, then the short positions become increasingly difficult to close without pushing prices substantially higher. This is what market observers mean when they say the shorts are insolvent. Not that institutions will go bankrupt tomorrow, but that the mathematical equation they entered into only works if silver prices remain suppressed and physical demand remains manageable. Both of those conditions are no longer true. Let's step back and talk about cycles. Markets don't move randomly. They move in patterns driven by human behavior, credit expansion and contraction, and the lag between supply responses and demand shocks. One of the lesser known but remarkably accurate frameworks for commodity markets is the Benner cycle, originally developed in the 1870s by Samuel Benner, an Ohio farmer who analyzed agricultural price patterns and iron prices. What Benner discovered was that certain commodities moved in predictable cycles based on crop years, financial panics, and industrial production rhythms. His iron price predictions, in particular, proved accurate for decades after his death. The Benner cycle has been adapted over time to apply to precious metals. According to this framework, silver specifically tends to enter major bull markets on predictable intervals following periods of consolidation and suppressed prices. Without getting lost in the specifics of the chart, the key insight is this. If the pattern holds, 2026 represents a pivotal year in the cycle where silver transitions from consolidation into expansion. Does this guarantee silver prices will rise? No, markets don't follow scripts. External shocks, policy changes, and unpredictable events can disrupt any pattern. But what the cycle does tell us is that the conditions that historically precede major moves in silver are present right now. That doesn't mean certainty, it means probability is shifting. And in investing, probability is what matters. Let's zoom out further and talk about the economic conditions that drive capital into hard assets. Silver, like gold, tends to perform well in environments characterized by currency devaluation, fiscal instability, negative real interest rates, and loss of confidence in government debt sustainability. Look around. Every one of those conditions exists today. Government debt in the United States has surpassed $36 trillion. Interest payments on that debt now exceed $1 trillion annually, more than the country spends on defense. There's no credible plan to reverse this trajectory. Europe faces similar challenges. Japan has been running unsustainable debt levels for decades. China's property market collapse has exposed hidden debt throughout provincial governments and state-owned enterprises. This isn't political commentary. It's arithmetic. When debt grows faster than the economy's ability to service it, the options narrow. Governments can default, which destroys credibility. They can raise taxes, which slows growth and creates political instability. Or they can inflate, which silently transfers wealth from savers to debtors. History shows that governments always choose inflation when possible. It's politically easier and economically less disruptive in the short term, but inflation has consequences. It erodes purchasing power. It punishes holders of cash and fixed income assets. And it drives capital toward assets that can't be printed. Real estate, productive businesses, and commodity-based stores of value like gold and silver. Central banks understand this, which is why they continue to accumulate gold reserves at record levels. In the past 3 years, central banks globally have purchased more gold than at any point since the end of the Bretton Woods system. They're not doing this because they believe in gold as an ideology. They're doing it because they understand the mathematical reality of fiat currency systems under fiscal strain. Individual investors are beginning to reach the same conclusion. Not everyone, not all at once, but incrementally, as confidence erodes and the gap between official inflation data and lived experience widens. This is the macro backdrop against which silver is operating right now. It's not the only factor, but it's the foundational one. If you already own silver, the question you're likely asking is, what should I do now? The answer depends on why you bought it in the first place. If you bought silver as a speculative trade, hoping for quick gains, this current environment might feel frustrating. The price has been consolidating for months, despite favorable conditions. Volatility has been muted. The explosive move some expected hasn't materialized yet. But if you bought silver as a long-term allocation, as insurance against currency devaluation, or as a position in a commodity with strong fundamental demand and constrained supply, then this environment should feel validating. Everything that justified the original allocation has strengthened. Physical demand is higher, supply remains constrained, the derivative market is more stretched, macro conditions are more supportive. The lack of explosive upward movement isn't a sign the thesis is wrong. It's a sign the market is still in the accumulation phase before broader recognition. This is actually the ideal time to hold an asset, when fundamentals are improving but sentiment remains subdued. The returns come later when recognition spreads and momentum builds. What you should not do is react emotionally to short-term price movements. Silver is volatile. It always has been. There will be days, even weeks, where price declines sharply for no apparent reason. There will be periods where nothing seems to happen despite positive news. This is normal. Commodity markets are driven by large institutions, algorithmic trading, and global capital flows that have nothing to do with your portfolio or your timeline. Your job as a holder is to stay focused on the structural case. Monitor supply and demand fundamentals. Watch central bank policy. Pay attention to real interest rates. Track physical demand indicators from industrial users. If those fundamentals remain intact, short-term price noise is irrelevant. One more point. Position sizing matters. If you allocated more than you can afford to lose or more than you can comfortably hold through volatility, then you've already made a mistake. Silver should be part of a diversified portfolio, not the entirety of it. If your allocation is appropriate, then the current environment is simply a waiting period. Stay patient, stay informed, and resist the urge to trade around noise. Now let's address those who don't currently hold silver but are watching the situation unfold. The question you're asking is, should I buy now or is it too late? Here's the honest answer. No one knows. Anyone who tells you they know with certainty where silver prices are going in the next month, quarter, or even year is either lying or delusional. Markets are complex systems influenced by thousands of variables, most of which we can't predict. What we can do is assess probability and manage risk. The case for silver right now is stronger than it's been in years. The supply-demand imbalance is real. The derivative market positioning is extreme. The macro environment is supportive. Historical cycles suggest we're entering a favorable period, but none of that guarantees prices will rise tomorrow. Markets can remain disconnected from fundamentals longer than seems rational. Price can consolidate or even decline before the next major move begins. So, if you're considering an allocation, the first question is, why? If you're buying because you saw a headline or heard someone say silver is about to explode, stop. That's not a thesis. That's speculation based on hype, and it will lead to bad decisions. If you're buying because you understand the fundamental case, you've evaluated your own risk tolerance, and you're comfortable holding through volatility, then the current environment offers an opportunity. The key is to avoid trying to time perfection. You won't buy at the bottom. No one does. The goal is to establish a position at a reasonable entry point relative to long-term value, not to predict short-term moves. Dollar cost averaging is a useful approach here. Instead of deploying all capital at once, spread purchases over weeks or months. This smooths entry price and reduces the emotional pressure of timing a single trade. Also consider the form in which you hold silver. Physical bullion offers direct ownership but comes with storage and liquidity considerations. Exchange-traded funds offer convenience but introduce counterparty risk. Mining stocks offer leverage to silver prices but carry company-specific risks. There's no single right answer. The appropriate choice depends on your goals, your risk tolerance, and your time horizon. What matters most is that you're making the decision based on understanding, not emotion. Now let's talk about what not to do, because this is where most investors destroy value. First, don't chase headlines. Financial media thrives on urgency and emotion. Every day there's a new crisis, a new breakthrough, a new reason to panic or celebrate. Most of it is noise. Your job is to filter that noise and focus on what actually matters: structural trends, fundamental data, and long-term probabilities. Second, don't over-leverage. The temptation when you believe strongly in a thesis is to maximize position size, use margin, or deploy capital you can't afford to lose. This is how careers and portfolios end. Markets can stay irrational longer than you can stay solvent. Even the best thesis can take months or years to play out. If you're forced to sell at the wrong time because you overextended, the thesis doesn't matter. Third, don't blindly follow influencers or online communities. Social media has created echo chambers where confirmation bias runs wild. Everyone is bullish together, everyone reinforces the same narratives, and dissenting views are dismissed as ignorance or manipulation. This is dangerous. Markets require independent thinking. You need to evaluate data yourself, consider alternative scenarios, and remain open to the possibility that you're wrong. Fourth, don't ignore opportunity cost. Even if silver performs well over the next several years, that doesn't mean it's the only or best allocation. Diversification still matters. Risk management still matters. Your portfolio should reflect your financial goals, your time horizon, and your ability to withstand volatility. Silver might be part of that, but it shouldn't be the whole story. Finally, don't mistake conviction for certainty. You can believe strongly in a thesis while acknowledging you might be wrong. In fact, that's the mark of disciplined thinking. The investors who survive and thrive over decades are those who hold strong views loosely, who update their thinking when new data emerges, and who never risk so much on a single outcome that being wrong becomes catastrophic. Here's something most people don't understand about major market moves. They take time. When a structural shift begins, when fundamentals change in ways that will eventually drive significant price changes, there's a lag. The market doesn't instantly recognize and price in new realities. First, the change occurs at the fundamental level. Supply declines, demand increases, financial positioning becomes stretched. Then, early observers notice. These are usually insiders, commodity traders, or institutional analysts who spend all day studying these markets. They begin adjusting positions. Next, the data becomes visible to broader market participants. Reports get published. Analysts start writing about it. Early-stage price movements begin. Then comes broader recognition. Financial media picks up the story. Retail investors start paying attention. Momentum builds. Finally, the late stage. Everyone knows sentiment is euphoric and prices reach levels that overshoot fundamental value. Right now, in silver, we're somewhere in the early to middle part of this process. The fundamentals have shifted. Some observers have noticed, but broader recognition hasn't arrived yet. This is actually the best phase to be involved because you're ahead of the crowd. But it requires patience. You have to be comfortable holding while nothing seems to be happening. You have to tolerate periods where prices move against you despite strong fundamentals. You have to resist the urge to trade in and out, trying to optimize every move. The investors who make the most money in structural shifts aren't the ones who trade the most. They're the ones who identify the opportunity early, size their position appropriately, and then do nothing while the market catches up to reality. This is harder than it sounds. Human psychology is wired for action. We feel productive when we're doing something, even if that something is counterproductive. But in investing, sometimes the best action is inaction. Sometimes the most valuable skill is patience. If the fundamental case for silver is correct, and the structural forces we've discussed continue to play out, then the returns will come. Not on your timeline, not smoothly, but eventually. Your job is to be positioned when they do. No analysis is complete without considering what could invalidate the thesis. What would need to happen for silver prices to remain suppressed or decline despite current conditions? First, a deflationary shock. If global credit contracts sharply, if economic growth collapses, if we enter a severe recession or depression, industrial demand for silver would fall. In such an environment, safe haven demand might still support gold, but silver's industrial component would be a headwind. This is a real risk. Central banks have raised interest rates aggressively to combat inflation. Higher rates slow economic activity, and the lag between rate hikes and economic impact can be longer than expected. A severe slowdown is possible. Second, a resolution of the derivative market imbalance without a price spike. If large institutions gradually unwind short positions over time without triggering a squeeze, if new supply sources are discovered, or if physical demand moderates, the pressure we've discussed could dissipate. This seems less likely given current data, but it's not impossible. Markets are dynamic and conditions can change. Third, a strengthening dollar. Silver, like most commodities, is priced in dollars. When the dollar strengthens against other currencies, it makes silver more expensive for non-US buyers, which can dampen demand. If U.S. economic outperformance or geopolitical factors drive dollar strength, silver could face headwinds despite strong fundamentals. Fourth, technological substitution. If manufacturers find ways to reduce silver content in products or substitute alternative materials, industrial demand could decline. This has happened in certain applications, and ongoing research continues to explore substitutes. Finally, policy intervention. Governments or regulatory bodies could change margin requirements, restrict derivative trading, or implement other measures that alter market dynamics in unexpected ways. Any of these scenarios, or some combination of them, could disrupt the bullish case for silver. This is why risk management matters. This is why position sizing matters. This is why diversification matters. No investment thesis, no matter how compelling, is without risk. The goal isn't to eliminate risk. It's to understand it, size your exposure appropriately, and ensure that even if you're wrong, the consequences are manageable. Before we conclude, let's clarify something important: the difference between speculation and investment. Speculation is buying an asset hoping someone else will pay more for it later. You're not evaluating cash flows, intrinsic value, or long-term fundamentals. You're making a bet on price movement, often over short time frames. There's nothing inherently wrong with speculation. Many successful traders speculate professionally, but speculation requires different skills, different risk management, and different psychology than investing. Investment is allocating capital to an asset based on an analysis of its fundamental value and long-term return potential. You're not trying to predict next week's price. You're positioning for a multi-year outcome based on structural factors. Silver can be either, depending on how you approach it. If you're buying silver because you think it will spike 50% in the next month and you plan to sell immediately, you're speculating. If you're buying silver because you believe the supply-demand imbalance and macro environment will drive sustained appreciation over several years, you're investing. Both approaches can work, but they require different mindsets. Speculators need to be nimble, disciplined with stop losses, and emotionally detached. Investors need to be patient, focused on fundamentals, and willing to tolerate volatility. The mistake is mixing the two, buying with an investment thesis but trading with a speculator's impatience, or speculating without a speculator's risk management. Be clear with yourself about which you're doing. Your strategy, your position sizing, and your expectations should align with your approach. So where does this leave us? We've established that silver is operating in an environment characterized by supply constraints, growing industrial and investment demand, extreme derivative positioning, and supportive macroeconomic conditions. We've discussed the historical context of market cycles and why patterns suggest we may be entering a favorable period for precious metals. We've examined what this means for those who already hold silver and those considering an allocation. And we've been honest about risks, uncertainties, and the importance of discipline. What happens next depends on variables none of us control: central bank policy, economic growth trajectories, geopolitical developments, and the collective decisions of millions of market participants globally. But here's what we know. The structural case for silver is stronger than it's been in years. The mathematical challenge facing short sellers in the derivative market is real. The macro environment is increasingly supportive of hard assets. Whether this translates into significant price appreciation in the next 6 months, 12 months, or longer is unknowable, but the probability distribution has shifted. For those positioned, this is a time for patience and discipline. Stay focused on fundamentals. Ignore short-term noise. Avoid emotional reactions to volatility. For those considering a position, this is a time for education and careful decision-making. Understand the thesis. Size your allocation appropriately. Be prepared for volatility. For everyone, this is a time to remain thoughtful, to continue learning, and to resist the temptation of certainty in an uncertain world. Markets reward preparation, patience, and discipline. They punish impulsiveness, emotion, and overconfidence. The situation in silver right now represents an opportunity to apply those principles, not because success is guaranteed, but because the setup is compelling enough to warrant serious consideration. Whether you act on that or not is your decision. But make it a decision, not a reaction. Make it based on understanding, not emotion. And make it consistent with your financial goals and risk tolerance. The investors who thrive over decades aren't those who always guess right. They're those who think clearly, manage risk intelligently, and remain calm when others panic or euphoric when others despair. That skill set applies to silver today. It will apply to whatever opportunity emerges tomorrow, and it will serve you better than any single trade or thesis ever could. The math suggests something significant is building in the silver market. The shorts may indeed face a mathematical problem they can't easily solve. The cycle may be turning at exactly the moment macro conditions become most supportive. But none of that matters if you can't execute with discipline. So stay informed, stay patient, stay rational. And remember, in investing, understanding the game is more valuable than predicting any single outcome. Thank you for watching.